The 7 best dividend-paying stocks that pay over $1,000. Welcome to our YouTube video on the top 7 high dividend-paying companies. Dividend stocks have long been favored by investors seeking stable earnings and consistent returns. These companies are well established and have a proven track record of sharing their profits with shareholders in the form of cash or additional stock. One crucial factor to consider when evaluating the sustainability of a company's dividend payments is the dividend payout ratio, or DPR. This ratio compares the total dividends paid by the company to its net income. It indicates how much of the company's earnings are being distributed to shareholders as dividends, versus how much is being retained for future growth. If a company's DPR exceeds 100% or is negative, indicating negative net income, it suggests that the company may be borrowing money to pay dividends. In such cases, the dividends are at a higher risk of being reduced or eliminated. Companies may also cut their dividend payments during challenging economic periods to conserve cash. Interestingly, dividend stocks, as measured by the S&P 500 Dividend Aristocrats Index, have experienced a decline of 4% in the past year, while the broader Russell 1000 Index has recorded a modest 1% gain. This indicates the need for careful selection and analysis when investing in dividend stocks. In this video, we will delve into the top 7 dividend stocks in the Russell 3000 Index, focusing on their forward dividend yield. We will exclude companies with negative payout ratios, or ratios exceeding 100%. So let's dive in and uncover some promising dividend opportunities in today's market. Number 1. Berry Corp. Dividend yield 19%. First on the list, we have Berry Corp, an upstream energy company that is making waves in the oil exploration sector within the United States. With a forward dividend yield of a staggering 19%, Berry Corp certainly grabs the attention of dividend investors. What sets Berry Corp apart is its impressive dividend payout ratio of 48%. This indicates that the company is efficiently distributing almost half of its net income to shareholders in the form of dividends, while also retaining a significant portion for future growth. Currently priced at $6.50, Berry Corp offers an intriguing investment proposition. Despite a challenging year for the energy sector, Berry Corp has demonstrated resilience, evidenced by its market capitalization of $0.5 billion. However, it's important to consider the one-year total return, which stands at -29%. While this figure may raise some eyebrows, it's worth noting that Berry Corp has been strategically positioning itself for success. In the first quarter, the company made a bold move by doubling its dividend to an impressive 12 cents per share. This decision was further supported by the nearly tripled revenue in the first quarter compared to the previous year, when the company faced significant losses of $162 million on oil and gas sales derivatives. Number 2. Office Properties Income REIT, or OPI. Dividend yield 16.8%. Now get ready to explore an intriguing high dividend stock, Office Properties Income REIT, or OPI. With a jaw-dropping dividend yield of 16.8%, OPI captures the attention of income-seeking investors. But what makes this real estate investment trust, or REIT, stand out? OPI boasts a solid dividend risk source of B, indicating a relatively low risk of dividend cuts. This makes it an enticing option for those seeking stability in their dividend income. As a REIT, OPI owns an impressive portfolio of over 160 buildings, primarily leased to high credit quality single tenants. The current occupancy rate of the portfolio stands at a robust 90.6%, while the average building age is 17 years. Notably, the US government holds a significant stake in OPI, representing 20% of the REIT's annual rental income. However, it's essential to examine OPI's recent financial performance. In its fourth quarter report for fiscal 2022, OPI reported a slight decline in occupancy from 90.7% to 90.6%. Normalized funds from operations per share also dipped by 6% compared to the prior year's quarter. Over the past 3 years, FFO per share have experienced a total decrease of 21% due to asset sales and lease expirations. Despite the impressive occupancy rates and high credit quality tenants, it's crucial to be aware of potential challenges. OPI's debt consists of more than 90% fixed-rate obligations, but with rising interest rates, we expect an increase in interest expenses this year. Number 3. Genco Shipping and Trading Limited. Dividend yield 15%. Okay guys, now come to the world of Genco Shipping and Trading Limited, an intriguing ocean transport company with a forward dividend yield of 15%. Known for shipping dry bulk cargo internationally, Genco is a fleet of 44 vessels that navigate the high seas. Despite the allure of its dividend yield, there are a few factors to consider. Genco's payout ratio is relatively high, standing at 91%. This indicates that the company is distributing a significant portion of its net income to shareholders as dividends, leaving a smaller amount for reinvestment and future growth. Currently priced at $12.59, Genco presents an interesting investment opportunity. However, it's essential to delve into the company's recent performance. Over the past year, Genco has faced a challenging journey, with a one-year total return of -44%. This indicates significant volatility and underperformance compared to other investments. In the first quarter, Genco reported a decrease in total revenue by 31%. The reduced rate of return from its shipping vessels played a role in this decline. Interestingly, despite not technically meeting management's conditions for a dividend payout, the board of directors recommended a dividend of 15 cents per share. This decision involved setting aside fewer earnings for future investment in order to fulfill the dividend commitment. Number 4. City Office REIT, or CIO. Dividend yield 14.5%. Welcome to our next exploration of City Office REIT, a high dividend stock that holds great potential. With a dividend yield of 14.5%, City Office REIT captures the attention of income-seeking investors. But what makes this real estate investment trust stand out? City Office REIT focuses on owning, operating, and acquiring high-quality office properties located in vibrant 18-hour cities in the southern and western United States. These target markets possess attractive demographic and employment characteristics, which City Office believes will drive capital appreciation and rental income growth at its properties. One notable aspect of City Office REIT's performance is its ability to grow funds from operations per share in both 2021 and 2022. This achievement is commendable, considering the headwinds posed by rising interest rates forecasted for the current year. However, City Office is expected to easily cover its dividend, with a projected payout ratio of 61% for the current annual dividend of 80 cents per share. Currently trading with a remarkably high dividend yield of 14.5%, City Office REIT presents a compelling investment opportunity. Moreover, our forecasts suggest minor growth in funds from operations over the coming years. Coupled with our belief in the upside potential towards fair value, the expected total return for City Office REIT surpasses 20% per year over the next 5 years. Number 5. Eagle Bulk Shipping Inc. Dividend yield 12%. Get ready to set sail with our next exciting stock, which is Eagle Bulk Shipping Inc., an international shipping company specializing in transporting dry bulk products. With a forward dividend yield of 12%, Eagle Bulk Shipping catches the attention of dividend investors seeking attractive returns. Eagle Bulk Shipping boasts a relatively low payout ratio of 44%. This indicates that the company is distributing a moderate portion of its net income to shareholders as dividends, while retaining a significant amount for future growth and investment. At a price of $40.60, Eagle Bulk Shipping presents an interesting investment opportunity. However, it's important to take a closer look at the company's recent performance. Over the past year, Eagle Bulk Shipping has experienced a challenging voyage, with a one-year total return of -37%. This can be attributed to a significant decline in revenue, which fell by 43% in the first quarter compared to the previous year. Lower charter rates played a significant role in this revenue decrease. Despite the challenging market conditions, Eagle Bulk Shipping remains committed to its dividend distribution. In the first quarter, the company announced a dividend of 10 cents per share. It's worth noting that the dividend has aligned with the company's earnings, as it has decreased alongside earnings. For example, in Q1 2022, Eagle Bulk Shipping paid a $2 dividend, which represented 49% of the company's earnings. Number 6. Calmain Foods Inc. Dividend yield 11%. Get ready to crack open the story of Calmain Foods Inc., an egg distribution company that has cracked its way into the spotlight. With a forward dividend yield of 11%, Calmain Foods presents an excellent opportunity for dividend-seeking investors. What sets Calmain Foods apart is its conservative payout ratio of just 20%. This indicates that the company is distributing a smaller portion of its net income to shareholders as dividends, while retaining a significant amount for reinvestment in future growth. This prudent approach provides stability and potential for long-term sustainability. At a price of $48.62, Calmain Foods offers an enticing investment proposition. Over the past year, the company has experienced a commendable one-year total return of 14%, outperforming many other investments in the market. Number 7. SFL Corp Limited. Dividend yield 11%. Okay guys, be ready to embark on a voyage into the maritime world of SFL Corp Limited, a Bermuda-based charter company that sets sail with a forward dividend yield of 11%. With a fleet of approximately 60 vessels, SFL Corp offers transportation services for various products, from chemicals and crude oil to dry bulk and vehicles. As we set sail into SFL Corp's financial waters, it's important to note that the company has a payout ratio of 70%. This indicates that a significant portion of its net income is distributed to shareholders as dividends, with the remainder retained for operational and growth purposes. Currently priced at $8.73, SFL Corp presents an interesting investment opportunity. However, it's essential to navigate the company's recent performance. Over the past year, SFL Corp has faced headwinds, with a one-year total return of -15%. This can be attributed to the decline in shipping rates, resulting in an 86% decrease in earnings per share compared to the previous year. Despite the challenges, SFL Corp remains committed to its dividend distribution. In the first quarter, the company announced a quarterly dividend of 24 cents per share. This demonstrates the company's commitment to returning value to its shareholders. While dividend yield serves as a valuable metric when evaluating potential investments, it provides a snapshot of the income a company pays to its shareholders in relation to the stock's price. However, it's important to note that a high dividend yield alone does not guarantee a smart investment. While dividend yield can help identify potential dividend stocks, it's crucial to exercise caution. Extraordinarily high dividend yields may be a red flag, indicating that a company is facing difficulties. Similarly, extremely high payout ratios can also be a cause for concern. Thank you for joining us on this exploration of dividend yield. We hope you gained valuable insights into the world of dividend stocks and how to make informed investment decisions. Happy investing, guys!